Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at MacNicol and Associates Asset Management.
Well, welcome everyone. This is our podcast, and we've got the pleasure of having Jeff Hirsch on the podcast from Stock Traders Almanac. And welcome, Jeff. Really look forward to the discussion and hearing more about your thoughts on what your forecast and outlook looks like.
I appreciate you having me on, Dave. Looking forward to chatting.
Before we start, I hear you recently had an injury?
Well, I had a hip replacement because it was a little bone on bone, and then everything's going great. But the other foot seemed to get have a little reaction to compensating. So we're just taking it easy on that one. But we'll be back on the golf course when the snow thaws.
Okay, I hope so. Yeah, I had a client, the same story this morning. Her hip problem, and they had to go back in and redo it. So
no, the hip's great. The hip is great. They killed it. I mean, it's better than the old one for sure. But just walking on the other foot, created a little bit of overuse on the opposite side. So.
Right. Well, let's hope Mother Nature heals you nicely. Time heals all wounds. So I think I'll just start with a little introduction on myself, just for those who are joining today or see it in the future, and then maybe get you to do the same. So my name's Dave MacNicol. I'm in my 40th year in this industry, and I still feel like I'm new to it. But I got my engineering degree at University of Western Ontario, just outside of Toronto, and I've decided I'd turn that engineering academia into sort of financial engineering. And we'll probably get into some things later if they come up, but today's meant to be more sort of informational and educational for anybody listening in. I've always worked on the buy side. I got my roots at a trust company in Toronto and got 6 years of really basic training there. And after that, I worked at a variety of partnerships and decided to go out on my own. It'll be 25 years this September that we've had this independent company doing lots of interesting things. Family of 3 adult children, boy, girl, boy, and we've been blessed with 2 granddaughters. So life is good. Jeff, maybe tell us a bit about yourself.
Sure. Well, like yourself, my father, Yale Hirsch, the man who started the Stock Traders Almanac, went out on his own back in the 60s, just before I was born in 1966, after working under the tutelage of our cousin Sam Koslow at Indicator Digest out of Palisades Park, New Jersey. He went out on his own and decided to take all the markets, cycles, patterns, indicators, and put them all together in a calendar format so that he could follow the market schedule along with his own. And he created the Stock Traders Almanac, which has been a big hit over the years. It is going into its 60th annual edition for 2027. I will be 60, so as old as the book. I was born, bred, weaned, raised on cycles, patterns, seasonality, looking at charts as a kid. But I had fought it for a while, looking to try to make my own mark, as people do. And one of my friends, my good friends, just said to me like this, Jeff, what are you doing? Go work for your father. And, this was in 89. And I had run numbers, done calculations for him. We used to do the almanac math by hand with an adding machine and a ruler and a pen and graph paper and all that stuff. I worked sending books out to brokers and advisors like yourself as a kid for years. But in 89, I joined forces with my father. And, we battled as fathers and sons do. But there was one moment we were sitting in the conference room. We do a bunch of newsletters also right now as yours. And thank you for being a subscriber and a long-time user of the Almanac. But we were debating some seasonal pattern. My father was making a case to some of the other writers and analysts in the room, and nobody got what he was talking about. It clicked in my head, and I was like, I get what I get what you're thinking, Dad. And from then on, I just sort of understood the mindset, and we stand on his shoulders. He created things like the Santa Claus Rally, the January Barometer, not sell in May and go away, but the best 6 month switching strategy, which I like to say you got to buy in October and get your portfolio sober and forget about sell in May and go away. But we do reposition there. I myself have two adult sons. One's going to be 21, one's 18. They're both at university. No grandkids yet, just a cat left. The wife and I are working on our new life as sort of empty nesters, but we're still going up and seeing the boys. They both play rugby, and which I played, so we go visit them, and we're looking forward to having them over.
Oh, that's
So
great.
yeah,
That's great. So,
life is good.
and I forgot to say, two important things in my life are my two dogs. So I'm
Yeah,
still a very proud dog owner. Here, I just want to put the book up on the screen. Hopefully, it shows up in front of. Probably not because I've got my little background thing on. Oh, yours shows much better. So this is a wonderful edition. As you say, your 59th, and I don't know if you roll over these quotes every year or not, but
I
there's some
do.
really strong ones here. Like William J. O'Neill, like he was a mentor of mine for years with the Investors Business Daily, and I think he left us in 2023. But I just want to read his quote here. Historical price patterns continue to work because human nature doesn't change, and neither does the law of supply and demand. Study past successful stocks if you want to know what future ones will look like. Stock Traders Almanac is all about historical facts. And I thought that was your strongest quote out of all these other
Thank you.
famous people and people that I know throughout our careers. But then, I don't know how many of your people actually read it cover to cover. We try to, but it's just
I
great
do.
when you lay it out every month. What's coming up in a really easy condensed table of contents. And oh, there's your father there. So he did it from, as you said, 1966 to 2000. And that's probably when you stepped in around 2000. And
Yeah, just before I got married, we did a little succession plan.
okay, okay. Well, I started mine in 2001. So we've got sort of the same
Yep.
longevity in a going concern. Yeah, so if anybody who gets this, I think they should encourage themselves to go through the month by month or just 1 month at a time while you're living it. And then I
People
just
ask me that question all the time, Dave. And I tell them, yes, start in the beginning, read the intro, learn about how we lay things out. But if you're buying the book right now in February, dial into February to the
yeah.
present, and go sort of backwards and forwards. I mean, it's made so you can read one page at any time, but definitely cover to cover. But if you're in a pinch, see where we're at right now. Go, read a couple pages before and after the current date on the calendar.
Well, that's why I just wanted. I'm not going to read through the whole introduction to everybody. They can do it on their own. But there's a great segment where you jump to page 54. I got it, page mark, and this is as you alluded to earlier, the sell in May, go away, don't come back till Labor Day. On page 54, it's the best 6 months, and it's just incredible the difference. The November to April gives you over a 7% return for the Dow, and the May to October gives you less than 1%. So it's just so different. I see what you're saying. The sell in May hasn't worked all the time. Like 2024, you would have been a mistake to do that. Who knows with all the money pumping into the system right now if 2026 will be a strong one. I'll give my comments on that later. But what are you thinking for this year?
Well, I mean, the past few days and few weeks, we've seen some increased volatility, but coming into the year and after the January barometer is positive, we're looking for, a more bullish midterm year because it's the second midterm year. We're looking for about 8 to 12% gain on the market. Um, but the market is struggling, is suffering from a little bit of growing pains and some consolidation. There's a bit of hair trigger reactions going on to things. So we're watching that. But for now, we're about 70% probability we're going to see the 8 to 10% gains. You can see the chart on page 11 sort of covers that. I've updated that in the newsletter service. But you were asking specifically about selling in May or repositioning in May, as we like to do. What that, how that looks for this year. Two things. it's the midterm year weak spot is Q2 and Q3, which lines up with the worst 6 months. And we also put out a little study you might have seen on the streaks, 9-month winning streaks for the Dow, which is impressive and tends to lead to further gains over the next couple of months, which would be February, March, April. But then the gains start to, mellow, start to wane, and it kind of lines up with the weak spot of the worst 6 months. So, and there's a whole a study, a whole strategy in the book about the overlaying the 4-year cycle with the best 6 months. So you buy at the midterm low and you hold all the way through to the post-election year, April, May, and then you trade back and forth post-election midterm year. So this would be a year that you would be trading at. Midterm year, worst 6 months tends to be a little more reliable on the not so great side than some of the other years. So wouldn't be I wouldn't be surprised if I see us tightening up some stops, selling some underperformers, and really limiting new long buying as we get through as we start to get into Q2 of 26.
How did you fare in last year in 2025?
We fared pretty well. The seasonal patterns got a little turned on their head after the tariff tumble or tantrum, whatever you want to call it, there in April, that low. So we got back in after getting washed out there, and that's when you don't just rely on cycles and seasonals alone, and you look to some of your other tools, fundamentals, technicals, and basically the tape itself. You don't fight the tape. So once we cleared some of that resistance, we were back in. But the seasonal, the best 6 months, worst 6 months wasn't all that great last year, because the worst 6 months were fantastic as we bounced off that April low. These things happen. But you have to overlay some other analysis and not just be one dimensional in how you approach the market.
Okay. Well, going back to the book, just curious, how many of these would you distribute hopefully going into the end of last year?
Well, when we were self-publishing back in the old days, we were doing 30 to 40,000 a year on average, and I think our peak year was about 77,000 or so just before I think it was the 2001 edition, which came out in 2000. We sold a lot of them. I mean, over 1.5 million books sold. I think now they're doing around 20 or so. But that's somewhat proprietary
No, I know.
information.
I didn't want to get to corner you there, but you've got John Wiley
Mhm.
as your publisher, and if I went and tried to publish my first book, I think they would take a pass on me. But that's just me.
It helps to have a little bit of history and
Yeah.
legacy. It is a benefit.
Now, how do you go through, like, there's recurring patterns, you carry those over year to year, and the calendar changes by a day, year to year type of thing. But are there any other, like, really challenging things moving it from last year to this year and so forth?
It was much more challenging before the advent of Microsoft Excel and Visual Basic and SQL Server and all these types of programs. A lot of it took a lot longer by hand back when I was growing up and coming into the business. So some of the shifts are there. I mean, I think making sure that things get, there's a lot of numbers in there, and making sure they're accurate from year to year when you go from the sending the files to the graphic designer, and things change when other people go to put them in. So I think the biggest challenge is making sure what the data that we compile and give to the designer is correct.
Mhm.
Gets copied and pasted incorrectly, and not sometimes something gets picked up because you do a template from the next thing. So I think that might be the biggest challenge. I mean, running the numbers and looking at the data and seeing how the patterns shift or change is one thing, but making sure that it's the product and the information is um, updated correctly by the different uh, team members that have to get their hands on it is the challenge. And then the switching of the intraday trading patterns, the daily trading patterns, the monthly cash flows. That gets a bit tricky with different trading days and how the calendar shifts. But we've done it for several decades, so you have kind of an eye for that.
And I would imagine nowadays a majority of your users are accessing you online and maybe just refer to the book from time to time. So there's a lot of great content on your website, by the way. So
Thank you.
see that. So
I think it's important to have something, physical by your side to check on. I mean, what happens when the electricity goes out? You get a power outage, or
yeah,
there's some Verizon, cell phone thing that went down, or some website crash. I mean, these things happen.
yeah. We'll talk about Bitcoin later, but how it's going to exist with such scenarios. But let's go back to one thing you comment about the sweet spot of the 4 year cycle.
Mhm.
And then you also referred to the weak spot talked about in the actual book. Where do you think we are in this cycle? And it just keeps sort of pushing as to where you see things going in the future.
Well, right now we're well into Q1 of the midterm year. The weak spot is Q2 and Q3 of the midterm year. So we are approaching that, where I suspect um, we'll see some consolidation of gains and some lower prices. I mean, on average in the midterm year, Dow and S&P are down about 2.5% over the 2-quarter combination, from April through September, and Nasdaq average is down about 6.6%. So that's the weak spot. The Q2 and Q3 of the midterm year. That sets up what we call the sweet spot, where you see this huge gain, from the fourth quarter of the midterm year to the second quarter of the pre-election year, where this time would be 26, Q4 to 27 Q2. That averages about 20% Dow and S&P over the 3 quarters, and close to 30%, 29.3 for Nasdaq. So that's we're basically approaching the weak spot. We're seeing some weakness here already. Maybe it comes a little bit earlier. I mean, these are averages over the year, so we may get a little weakness in the middle of the midterm year, either earlier or later, depending upon events that transpire that trigger that. I mean, the election, the midterm election themselves, that battle, which is going to be pretty heated this year, is what creates that uncertainty, that historic uncertainty there. And we've got some other uncertainty factors going on with AI and Bitcoin, as you alluded to, amongst other things. Bitcoin has an interestingly horrible midterm election year history. Not that there's that many of them, but so I think a little patience is gonna be in order for the market. It's being tested already, as I'm sure you felt with your portfolios and your clients. People are getting a little bit antsy right now.
Well, actually, we're I don't know, we're fortunate that we saw certain things coming for a few years now. Is this inflation cycle that we find ourselves in? We think it's very similar to the 1960s and the 1970s. Nothing's ever exactly the same, of course, but the same thing was going on then. That governments of the day thought they had inflation under wraps, and they didn't. It was one of the worst inflation cycles in history, and we see something similar going on right now. And we've got one analyst who thinks that interest rates might recircle themselves back to the old 1981 highs, not in a 40-year time horizon like the last cycle happened, but in more like a 10-year time horizon. So that's one of our extreme outlier analysts that we listen to a whole array of them, and we definitely at these turning points don't just go down the middle and deal with the average of them, because that just doesn't work at these turning points. So inflation, maybe talk a little bit what your thoughts are on inflation are, and how you see this cycle working out.
First of all, I think the Fed's target rate for inflation is wishful thinking, pie in the sky of 2%. A simple average of CPI going back to, just post World War II, using the Fred database, is like 3.1%. So, and that's an average. Yeah, we might go a little bit below it, but I don't see inflation ever getting towards 2%. It seems to have uh, stopped increasing, but I think we've probably hit a low. Things continue to get expensive wherever you go. Just anecdotally, as a consumer, as a person out there, um, but it is something that's on our radar. I don't see it necessarily perking up to the levels of 81, like your extreme analyst says or thinks or is concerned about right away. But I, the one thing that may actually be beneficial from this AI craze, which I think is huge. It's like the microprocessor of the late 70s and early 80s that created the last super boom. You know about the super boom pattern that we put out there, the forecast that I made. The productivity increases down the line, I think will keep inflation in check. Right here in the short run, there's going to be a bunch of disruption. We're seeing those reactions across the different sectors in the news the last, several days and weeks. But down the line, it's going to increase productivity, which will keep inflation lower. But, inflation is, from our view and what we wrote about in my Super Boom book about the whole chapter on inflation, is really driven by government spending. And that doesn't seem to be waning. You can do whatever you want with interest rates, but it's all about the money supply. And when the government spends a lot of money, like it did during World Wars One and Two, and Vietnam, and then the COVID spend was very similar, much like a wartime government spend, uh, without question, is what created the last, the 22 inflation. So, spending, federal outlays is the kind of thing we look at, and also just we one of our four horsemen of the economy is the CPI and PPI. We use a 6-month exponential moving average to sort of track it. Seems to be in check right now. It seems to be under control, but it's always something to keep an eye on. So I'm not so concerned that inflation is going to ramp up to these levels from the 80s with the increase in productivity. But the government spending is where the problem is.
Mm-hmm. Well, that's just it. These governments, doesn't matter what the party is. And by the way, we don't get political here. And even when talking to our clients, we try to stay down the
Yeah,
middle because
me too.
you never
You
know
have to.
who's voting one way or the other. And frankly, at the end of the day, I cynically think it doesn't make a great deal of difference. But, you had the run up in the 70s again that I alluded to before, where several Fed chairs thought they had things under control, and they clearly didn't.
Nope.
So Paul Volcker, as we know, had to come in around 79, and he raised short-term rates from like 4% up to 12, so 8 percentage points. There's no way if inflation does start to run away here that the governments of today can afford that. They would be
No way.
shooting themselves in the foot with the amount of debt we have now compared to the 70s. So it's a real problem, and this is why one thing we have is some downside protection for our clients. And I don't want to get into a whole plug here,
No, please.
but what if there is a serious downside correction? We haven't had one arguably since the credit crisis, which ended in 2009. We've had a few blips then, with COVID, and 2022 was another short-term effect. But we really haven't had a significant setback that earlier in my career you could almost set your watch to. So we've got a partner in Universa who provides us with downside protection for a very small sliver of our clients' portfolio. We don't want the market to crash, nor do I want my house to burn down, but I have fire insurance regardless. And
Sure.
so that just what you go into you talk about more of your super cycle. You alluded to it a moment ago. Maybe
Yeah.
just paint a forecast for us that way.
Well, I mean, it's called the super boom. It's a super cycle for sure. It's something Yale discovered back in 76 that the market tends to make these 500+% moves following war and inflation. When we went back and noticed that after the aforementioned real pullback in 08, 09 that you mentioned, um, we we realized that there was another factor involved, and it was a disruptive technology, what I call a culturally enabling paradigm shifting technology. It was the microprocessor, which led to the internet and all that stuff in the 80s and 90s. And throughout history, there have been these other things that changed the world collectively and all of our lives individually, like, indoor plumbing, the automobile, air travel, refrigeration, the interstate highway, all these kinds of things. I am under the impression that this AI tech boom is of that ilk. It seems to be touching everything and everybody. It's early on, and that's part of the super cycle. There's also part of the functional, government aspect of the super cycle where you want the parties and the branches working together and compromising and coming to some sort of consensus. We're having trouble with that lately. We've had a lot of these shutdowns, partials and otherwise, at least in the U.S. and stuff overseas. I mean, back in the Reagan and Tip O'Neill days, things got ironed out. Even Clinton and Gingrich ironed some things out. We're not seeing that right now. We had for a little bit, but that's another thing. So, and then you mentioned Volcker, and I really appreciate that because we had gone back when they first started talking about the inversion. That was the worst inversion of the yield curve since '81. We went back and pulled up some of the old minutes. And if you go in there and look at it, Volcker's talking about, I'm not going to quote it perfectly. I've got it bookmarked somewhere, but it's basically if the bond market goes outside of this range of 15 to 21% was the range it talked about, we'll go in and make some adjustments. So the Fed was set up to put guardrails on the market, not to lead the market. And what we've seen recently and in the past several Feds is this drive and desire to just be out there jawboning and talking with and just this Fed speak. Like, enough already. Who said it was your job to go out there and make presentations and talk about this stuff? Go back and do your research, see where the economy and the markets are going and where the money flows are needed, and make your adjustments and put the guardrails, on the bond market and make sure, it's refereed and not, trying to lead where interest rates should be going. They're supposed to be following, not leading. So that's one of the issues. The super cycle, back in 2010, when we noticed this pattern forming again, we put out a forecast in our newsletter for Dow 38,820, which was a six-fold move off the intraday low of March 6, 2009, which is the same math that Yale did in 76, was 3420. So that was at around Dow 10,000. We cleared that. We're up at 49 now. With a little bit of hindsight, you see that the secular bear market ended like it did in 82, not at the low in 74 in 2011. So extrapolating forward from there, that puts us up to Dow was 62,430 if numbers. I think it's actually in the forecast outlook in the almanac that you have. So that's the super cycle. There's a nice chart of it there. The 500 moves. 62,430 is the number from the October 3rd, 2011 Dow low, closing low of 10,655.30. So not that we're not going to have a cyclical bear in between here and there, but I think we could probably get there given the average, annual return for the Dow of about 8.5% by 2030. I think your concerns, your fire insurance for the portfolio is important. We like to be somewhat diversified, and we use our seasonal approach overlaid with fundamentals and technicals to protect ourselves. But I don't think the secular bull is over.
Mm-hmm. Yeah, no, I don't disagree. I believe that there's a final melt up going on right now, but it's just you don't know when that ultimate
Nope.
peak is, and it's only in hindsight when you look back, typically 6 months or thereabouts. You point to some peak and you go, "That's what it was. That was the one turning point that caused it all." But at that point, all bets are off, and people are just not investing anymore. They're on a holding pattern. They're hoping that the bond market will pay off and soften the blow. We've been against bonds ever since the credit crisis. We stopped investing in our retirement accounts into bonds and focused on alternatives. And we've had a strong alternative asset platform going since 2010. And but inflation is a problem. I keep harping on it. What do you see in the gold and the precious metals markets going forward?
I think we've seen the top in the near term. It definitely got ahead of itself, but there's some central bank buying. There's the inflation hedge going on there. It was a seasonal trade we did well with last year. I'm not a huge gold bug, but I'm not so sure people should start buying more of it right here. Um, but it's definitely worth holding a portion of. I like copper. I'm in the copper miners right now. We got in that end of October. We put out a recommendation there in the newsletter. Got in on a little bit of a dip in November. Hit the seasonal low very nicely, and it's one of the better performers out there right now, especially in our sector ETF portfolio.
Yeah,
So
well, if electric vehicles are going to still be a thing, which appears they will, and just the whole build out of this AI space, that's copper's
vehicles in general,
yeah.
construction. I mean, copper is one of the things that the physical world is built on, that the
Mhm.
artificial intelligent and digital world resides on.
Yeah, yeah, and fortunately, there aren't any real shortages of it like there are in other metals. That's why we tend to stay on more the precious side. And but I think there's just a whole global boom going in commodities again. That cycle seems to be coming back,
Yep.
where financial stocks don't do as well, and now commodity type stocks do especially well. So sort of like a 20, 22 year cycles that. Last stopped when we both started into our new businesses here.
Yeah. One of the reasons we are bringing back the old Commodity Traders Almanac that we last fully published in 2013, we are in the process of putting that together for next year's edition. Should be out this summer.
That's very wise. Okay. Maybe just starting to wrap up here, and then we'll just talk a little bit more about our businesses and how to access them. The economy. Let's finish up on that. What is your thoughts? And is there a recession around the corner, or how long can that be postponed? Even after we've had an inverted yield curve in the past a few times, but the economy seemed to ignore that.
Yeah, I don't think the inverted yield curve is such a great indicator. Um, Going back to the recession that they said we didn't have in 22. The first 2 quarters of 22 were negative GDP. I know they changed the rules during COVID for declaring that, but I believe we had a recession back then, and there was a classic midterm year bear market, which was textbook 4-year cycle, worst 6 months, almanac material right there. So I think we did have a recession there. I don't see one on the horizon right now. Of course, things can change. The you know GDP numbers are pretty solid. Corporate earnings are solid. Amazon's revenues were up 16% over last fourth quarter last year. One of our stocks, Boot, up 20% or something. I mean, there's a lot of whisper number disappointment going on out there, but beneath the surface, there's still economic growth. There's still improvements in corporate results. Not everybody. The jobs market is a healthier than it feared initially. Yes, it's not as perfect as it was a couple of years ago, but we look at initial claims and not seasonally adjusted, and that seems to just be normal. And the recent spike over the holidays was just that. It was a seasonal spike. So I'm not seeing any recessionary signs. I know everyone's trying to sell that fear. It's always something to keep an eye on. And we look at that every month in our, market at a glance. We're constantly looking at it, but we run through that, and the economic readings and the corporate readings still seem to be indicating that the economy is resilient and healthy, and we're still growing, and it's not an imminent concern right now.
Yeah. No, I tend to agree. The market has to climb the proverbial wall of worry. There's still a record amount of cash sitting on the sidelines on this final melt up. You're going to see a large chunk of that cash get into the market in various levels, and will push things up to even higher valuations. And we're already at the highest valuations that we've seen in the markets, but we'll see even higher highs, driven by potentially lower interest rates.
This
So
is this is
it's,
a
yeah,
an
sorry, go ahead.
important point you're making there, Dave. Some of the old research that I did when Yale was around, and it's not a secret. The lower interest rates, the higher the PE multiple.
Yeah, yeah. No, and if certain um, politicians get things pushed down the way they'd like, it's going to be more inflation and higher valuations, higher PEs, until it doesn't work. It's literally, I hate to liken it to a game of musical chairs that we all played when we were kids at birthday parties, but
I still
that's
wonder why the U.S. didn't refinance its debt when rates were so low.
I know it would have been
I
genius.
mean, we all refinanced back then. I mean, what were they thinking?
Yeah, well, you see the technology companies doing 100-year bonds now, and
Yep.
going to other markets outside of North America and outside of the States to raise that in different currencies, and so they're the ones they're the leaders, and something will have to change. Your government will be issuing super long-term paper. They'll have no choice, but time will tell with that. So let's finish up here. How do people get a copy of the Almanac and get access to your website and your services?
Well, the StockTradersAlmanac.com, our website, is the place to start. If you take out a subscription, you get a free copy of the Almanac every year. I mean, if you just wanted a copy of the book, you can get it from Amazon or wherever you want. But you don't. You'll get our, daily market, our weekly market calls, our stock picks, ETF recommendations, and our seasonal calendar updates with the newsletter. A lot of stuff that I was talking about today. So you go to stocktradersalmanac.com. There's a little Get STA tab there. You can click on that, and there'll be a discount code in there you can use. If you also go to try to log in, you'll see, or go to Stock Traders Almanac. You do /7 days free. You get a free trial, and we'll continue to update you. So also track me on social at Almanac Trader, and there's links all over the place. You can just Google it, you'll find it.
Okay. And what type of investor benefits best from using it?
I think we cover a lot of bases. I think there's some long-term investors that look at some of the historic patterns. There's some swing traders, and there's even some day traders on there. I think it's the investor or trader that likes to incorporate cycles and patterns and history and human behavior into their analysis and style.
Okay. And then just a final plug for our business. As I say, we'll be 25 years old this September. I still feel like I'm a teenager, but that's okay. We're doing lots of interesting things in the investment space, both in Canada and the United States, where we've got a SEC license. And yeah, everything from alternative assets. We've got an award-winning platform in that's over 15 years old of audited numbers. We've got our downside protection that's available in Canada. We've got the Safe Harbor Fund, where we've got the Canadian rights to that. And then in the US, through a good long-standing partner of ours in Lions Crest. And then, of course, our stock picking. We use everything related to the Stock Traders Almanac for a good part of it. We also use momentum models and a variety of other things that really do look at the fundamentals, and we're not just a bunch of chartists. So if you want to look us up, on the screen should be the US website is MacNicol.com, or the Canadian website is maam.ca. And as they always say, follow, like, and subscribe, and comment if you have any question or anything. We'll try to get back to you. So I think that covers both of our ends. Do you have any final comments before we sign off?
Yeah, I think one thing I want people to keep an eye on is the February 5th low over there, and also the December closing low. Those are kind of lines in the sand we're watching for breakdown. But otherwise, growth is there. The bull market's still intact, and I think we've got a good buying opportunity later this year. the sweet spot of the 4-year cycle, and history of gains from the midterm low to the pre-election year high are pretty solid.
Okay, well, that's great, Jeff. Really appreciate you and everything your group puts together. I know it's not a one-man show. It can't be. There's not enough hours in the day for you to complete all this. So well done, and thanks for this.
Thanks, Dave.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit MacNicolasset.com to learn more.